For me personally, I struggled so much with trying to find a daily bias when I was learning how to trade. This for me was like definitely the hardest part of it all. I think there was a point where I wrote down somewhere that, if there was anything that I could know 100% guaranteed going into the market, it would be what way the market was going to move for that day, right? Obviously, that's how we can capitalize on some winners. We want to be able to know what way the market is going to want to go for the day. As we can take a look here, as we can see, we've got market coming down, we've got market moving sideways, we've got market moving up. This shit moves up, down, left, right, absolutely every single time, all right? Maybe not left and right, but you get what I mean, right? All I wanted to know was, how do I know what way I should be looking to take a trade? Because there would be times I'd set up, I'd be ready to go in my session with my pair, and I would just be looking at the charts. I'll see a short setup happening, I'd capitalize on the short setup, I'd enter into that, and then a long setup would happen just after it and continue higher throughout that day. So how do I know that I shouldn't be looking to enter that short position and instead be looking to enter the long position for that example, right? That was the biggest struggle for me, and that is what I struggled with, but that is what this video is here to do. It is here to make it seem so much more simpler using a concept known as the daily draw on liquidity. And this is what I use to find my daily buys each and every single day. So there's a couple of little concepts that we're going to go through, but let me make it pretty simple. Let me start up here first, and we'll just break down what it means. So obviously on any given day, we're going to have a bullish day. Hang on, let's redo this. We're going to have a bullish bias, and we're going to have a bearish bias, right? Those are the 2 days that we're ever going to be trading within the market. There is, of course, one other day, but that is a no trade day based on some other things. It can also be based on this. But for now, bullish bias, bearish bias. How do we know which one we have in the market? So for a bullish bias, we want to see yesterday's candle close above the high of the previous candle. This will make a lot more sense once I draw it out in that. But in order for us to have a bullish bias for the day, we want to see yesterday's candle. Let's say we're trading on a Wednesday, right? Yesterday's candle would be Tuesday. We want to see how Tuesday's daily candle, do this on the daily time frame, of course. Tuesday's daily candle, if that closed above the high of the previous day, being Monday, then on Wednesday, we would have a bullish bias. We could look to take a trade. Similarly, actually, no, not similarly. That's for bearish. Alternatively, we can have yesterday's candle wick below the previous day's low and close back above. So of course, if we're looking to trade on a Wednesday, we can look at Tuesday's candle with the low of Monday. If we move below that but then close back above it, that can also be a bullish indication for our trade on Wednesday. Then of course, on the bearish bias, you would just be flipping what I just said. So it would be yesterday's candle close below the low of the previous day, of the previous candle, right? On the daily time frame, of course, but we would want to see a close below that previous day's low. So for the Wednesday, we are looking at Tuesday's candle, how it reacts with Monday, closing below that low. We would have a bearish bias for the Wednesday, and then of course we would also have yesterday's candle wick the high of the previous day, day's high, and close back below it, right? This will make a lot more sense once I show you some examples, but write this down if you want to, and then you can draw some examples or take photos of the examples, whatever it is that you're doing. But this is how we find a bullish example, a bullish bias, and a bearish bias for the day. So write that down if you want to. Let's delete these and let's just jump into the chart here, and we'll just chuck it into replay mode, and I can show you just how we use the daily draw on liquidity to find our bias. So using what I just explained, as we can see, we are not looking to see how we can trade this day. We are coming into the market, and at the bottom you can see it says Thursday. Thursday is the day we are looking to trade. We are looking to predict which direction this candle on Thursday can go. How do we do that? We use the Wednesday candle on the daily chart, of course, and how Wednesday reacted with Tuesday. So this is the yesterday candle. This is the previous candle. In order to find Thursday, we are looking how Wednesday reacts with Tuesday. So as we can see, Wednesday's candle is a open high close low, giving us a bearish candle, and we close below the low of Tuesday. That, of course, would mean we can look to target the previous day's low being Wednesday on our Thursday, because we close below the low of Tuesday with Wednesday. We have a bearish bias coming into Thursday. Play price forward, and we can see that the Thursday candle did in fact trade lower and give us another close below the previous low. So again, in order to find Friday's setup, we would look at Thursday's candle and how it reacted with Wednesday. So Thursday closed below Wednesday's low. We would then look to trade lower on this day. For Friday, as you can see, we would have been having a bearish day for Friday again. Then it's a little bit tight, but we can see that we just closed below the previous day's low. So that means, of course, again, we are looking to take a trade lower. As you can see, Monday's candle also closed below the low of Friday, giving us a bearish draw on liquidity for the Tuesday. We would mark out the lows, and that can be our target. We continue doing this. Obviously, as you can see, when it's in a trend, the shit runs like pretty smoothly. It's very, very simple. You don't have to chop and change too much, but hopefully we do get a little bit of a change soon. So again, we close below the low, we target the other low, we close below that low. We just keep going until eventually, oh shit, I pressed play instead. Until eventually we get something like this. So as we can see, we did not reach our daily low. That's absolutely fine. It's definitely not going to be hitting each and every single time. That is for sure. So unfortunately on this day, we either would have taken a loss because the market moved against us, or we wouldn't have even had an entry opportunity. It just depends, right? Obviously, just hitting the daily draw on liquidity does not mean that every single one of those days is going to be a win. It just means that, you know, the direction of the market was correct for the day. And it gives us a good indication of what we can expect in the future. But we don't have a daily draw on liquidity get hit for this point, for this Thursday. What happens when that happens? So obviously we targeted the low. We can then look how our Thursday candle reacted with the Wednesday candle anyways. And it closed above the previous day's high. So that would mean we are now looking to switch our bias to a bullish bias for the day, because yes, we didn't reach our daily draw on liquidity. That's absolutely fine. We just look at whether or not the previous high or low, whichever the alternative one is, if that got reached instead. As we can see, it did. We would look for a long on this day, and by playing price forward, we can see that we do trade higher throughout that day. And then, of course, this is a great example of how we can find the bearish bias when we don't close above or below. As we can see, we did reach the daily draw on liquidity. We come back and close back below it, giving us an indication to look lower. That would be a bearish trading opportunity. And as you can see, we continue lower throughout that time. So we basically are just following this. We have the 4 reasons, of course, that we're looking for either bullish or bearish in terms of our bias. We just want to focus on how yesterday's candle reacts with the day before, right? Pretty simple. You will get the hang of this super, super quick, because it starts to become second nature pretty quick. It's not that hard. So let's keep going, right? We have Monday closing below the low of Friday, giving us a bearish bias, bearish draw on liquidity. We continue lower. We close below that mark again. We will target lower. We wick this and then close back above. As you can see, we wicked the previous low, closed back above, as well as closing back above the previous day's high. So basically just 2 confluences that we would look to change our bias, and we would look to go higher. We hit the previous high again, closing above it. Another bullish day to be targeted. We close above again. We would look to target again a bullish day. Sometimes you do get a candle that looks like this, right? So obviously it's a bullish day, so potentially we still would have been making a profitable trade. Obviously, as I said before, it depends on other factors. But at this point, obviously we had the Friday close up here. Friday close up here, the Monday open all the way down here. So sometimes there is a weekend gap, but you know, we're not focused on the weekend gap at the moment. But Potentially we could have made profit on this. Do we hit the previous day high that we were targeting? No, we do not. What do we do then? We then look for the previous day low, but as we can see, that was also not hit. So what am I doing on a day like this where neither the high or the low gets wicked or closed above or below? I'm taking a day off. Literally, take a day off, man. You don't need to trade every single day. The best traders in the world aren't trading every single day. So why the heck do you have to, right? This is just a free Tuesday. Go do whatever the heck you want. Now we're going to be coming back and seeing after this Tuesday gave our price action all that movement, we can see we just basically continue from where we were. So we had the Tuesday closing above Monday's high. We of course can continue and go for a bullish draw on liquidity, closing back above that high again. We would continue higher. Now we fail to reach the daily draw on liquidity, which is absolutely fine because as I said, not every time we're going to hit the draw on liquidity and we may have been taking a loss. That's fine. What do we see happens after that? We close below the low of Wednesday, giving us a draw on liquidity now to the downside. We just flip our bias and now we're looking bearish. We continue bearish. We close down again, looking to continue bearish again. This one, we do not wick either the bottom or the top of that candle. So again, another day off. It's no sweat. Take a day off. Again, another day off because we don't reach either the high or the low. Okay, and another day off. So it looks like you're getting like almost a whole week off here, but it's better than trying to force yourself into the market and basically take a guess at what way the market wants to take it the certain direction. Holy, what the hell? That doesn't make sense. Anyway, now we're back in and we can see that we wick below the previous low and close back above that. We can have a bullish draw on liquidity. We do get a bullish day. We don't get a hit of the target. So we're taking the next day off. Then we do get another bullish move up. We can look to take a bullish trade again, potentially. We wick this, we close back below. We switch, we look bearish. We close below, we continue to look bearish, looking for sells. We wick this, we close back above. We switch to the bullish. You can see how quickly like I'm doing this, especially this little bit where we're switching. Like it just becomes second nature and it becomes really, really easy to understand this. You're no longer going to have to be like finding traders when they're live streaming and asking them for the daily bias, what they're looking for, this, that, the other, because first of all, no trader looks at the market the exact same way. Every single trader looks at it differently. Otherwise, if everyone viewed the market the exact same, this shit wouldn't work, right? It wouldn't function. And then secondly, you're going to have this coming out as second nature, so it's just going to be really easy for you to do instead. And it's much less stress as well. Like the way I was taught in how to find daily bias when I was first sort of learning and all of that, it was very, very subjective, right? In terms of, okay, what are you thinking it looks like? And it's like, well, what I think it looks like isn't what someone else thinks it looks like. So if majority of people thinks it looks like what that guy thinks, then I'm fucked because I'm going to be taking a loss when everybody else is going to be taking a win that think it looks like that. So it was very subjective in that sense. This one, it's not subjective. The market is, as you can see by the concept, the market is telling you where it's likely to go and where it possibly can be moving in that future day, right? So that's why it works so easy. And literally, once you practice this, it'll become second nature. Like, I know I've said it a lot already, but watch this, right? We have a close above the previous high. We would look for a long. We have a close well above that previous high. We would then look for a long. We have a wick above the previous high, closing back below it. We would switch our bias, look bearish. We close bearish below the previous low. We would continue to look bearish. We wick below that low, close back above it. We switch our bias to look bullish. We hit the bullish draw on liquidity. We close back below it as well as closing below the low. We switch back and we look bearish again. We switch back because we wicked the previous low, close back above it. We're moving higher, right? As you can see, it is very, very second nature to me. Like that takes what, 10 seconds, not even, to figure out 2 weeks worth of price action. So it is a very strong concept and it definitely does work. Now there is one other factor that we have to implement into this as well, and it is known as the swing point. So I'm going to erase all this. I'm going to just take it to a different part in the charts and we will look to see if explain the swing points, which is really quite simple to do. So let's just go and do that. Okay, so what is a swing point? To keep it simple, a swing point is basically just a high and a low within the market, but on the daily time frame. That's all we're worried about, is the daily charts, highs and lows, okay? That's what we're looking for, and that is what can influence our daily draw on liquidity as well, and potentially switch our bias based on what we just learned previous. But if we take a look, as we know, the market creates highs and lows all the time, and what is resting above highs and lows? Liquidity. So at these points, let's say we can just mark some of these out. This is the daily high at the minute. That would become a swing point. We have a daily low down here, which would also become a swing point. So when we are tying in our daily bias with the daily draw on liquidity by marking out this previous low, because we wicked above the previous high, closed back below it, we can continue to normally look for our daily draw on liquidity, being bearish at this example. And now, as we can see, super strong move down, but then a strong rejection again to the upside. This would, of course, give us a bullish daily draw on liquidity. We would then play price forward, and we continue to get a push past this, closing back above. So we would have our daily draw on liquidity be bullish again. The daily draw on liquidity is normal, but you just want to be targeting your daily highs. You want to have them marked out because of this example right here. Okay, so for our Tuesday, we were looking to take buys on the day. We can see we were successful with those buys, and we had a daily high that we marked out over here being our swing point. Now, the reason swing points are so important and why we need to keep track of where they are on the market is because obviously we can use them as targets. That is another reason that we can use them, but the main reason is because of setups like this. So as we can see, Tuesday closed above the previous day's high being the Monday. We would, if we weren't looking at swing points, if we only learnt what we did just before, we would be looking for a buy. This would be our old daily draw on liquidity without learning about swing points. As we can see with the swing point, this is kind of like a major draw in liquidity, I guess you could say. So we have our high, we wick above it and close back below. It's the same concept with the draw on liquidity, but just based on the swing point, of course. So with our daily draw on liquidity, it would be bullish because Tuesday closed above Monday's high. The swing point, however, was wicked past and closed below. Now the swing point often, I'm not going to say always, but often holds more power than daily draw on liquidity. So if you have daily draw on liquidity conflicting with the swing point actually holds a bit more power. So this would be my true daily draw on liquidity. That would be the true point that I would look to trade. I would not be looking for a buy on this day. I'd be looking for a sell, because although we had a bullish draw on liquidity, we had a bearish swing point setup. And as we play price forward, we can see we absolutely dumped down through the market. Instead of pushing higher like we thought, we did push higher a little bit. So possibly there could have been a short caught, but we are not looking to just catch this little move. We ideally would be great if we could catch moves like this all day. Obviously, these winners and losses depend on other factors that we're not getting into just yet. But as we can see, we then push bearish on this day. We have our swing point down here that we targeted. There was a swing point in here, but as we can see, it got pushed past, so that will be ignored. Bro, say your words properly. Anyway, this swing point, do we close below it? No. But as we can see, Wednesday's candle closes below the low of Tuesday. So we would normally, just using our daily draw on liquidity, look for a short. But based on the swing point setup, we don't close past it. So we fail to, I think it's called failing to displace, right? We fail to displace past this. That would mean the swing point holds higher value. I would look to target a daily draw on liquidity to the upside instead of the downside. So I'd be targeting longs instead. Obviously, I don't think the market would move all the way up there, especially not in one day after just moving all the way down. But we'd play price forward and we can see that we get a bullish candle. It is a bit indecisive. There is, wicks either side, but we do trend a little bit lower and then trade up. We do end up having a bullish day. So then we basically just continue our daily draw on liquidity, and then we implement our swing points, right? So unfortunately, we wouldn't have had our daily draw on liquidity get hit there, but you do also want to zoom out and just make sure that you're marking up all of the swing points that price is potentially reaching. So just highs and lows, we know how to mark those out, just like so. As we can see, we'd closed below this swing point. We also closed below the previous day's low. We would look for a short on this day, playing price forward. Okay, bad price action, but did not reach anything. So what are we doing when we don't reach anything? We're taking a day off. We do get our close below this previous day low, and this little bit in here would actually become our swing point as well. So make sure that you are updating your swing points. But as we can see, we close below it ever so slightly, but still 0.6 pips below. As we know, my break of structure rule is 0.5 pips. So for me, I'm going to be counting that and then looking for a short in the market potentially. And we of course have this swing point down here too that can be used for a target. Price didn't want to move that way on this day, but as we can see, what happens again, we wick the previous high and close back below it, giving us another bearish draw on liquidity. We do get a bearish day, but we didn't reach the draw on liquidity. We do wick above the previous day's high again and close back below. This also becomes our swing point, don't forget, because it's now a low on the daily time frame, and the next day would be bearish. And that sometimes you do have to be patient, right? So obviously through this, we would have taken that short there, we would have taken that long, we would have missed this short, but then what was it? We would have had to be pretty patient through this section. We would have had potentially a successful trade in here, but then eventually we do get that push down and we close past our swing point. We come over here, just make sure there's no other daily lows, which there is not. So closing below that swing point and below the previous day's low, giving us draw on liquidity to the downside, as well as a swing point setup. We continue lower, and then it's back to basics with the daily draw on liquidity, obviously not hitting every single time. So pretty well, as we can see, you just need to keep track of where your swing points are, being the highs and lows, because they hold higher forms of liquidity. The daily draw on liquidity is a high form of liquidity, but then of course the swing point is even higher, right? So this one up here also becomes a swing point, which we just want to mark out like so. And then based on closing above that previous day's high, that becomes that becomes our draw on liquidity. This one down here becomes a swing point. Play price forward, close above, look to continue higher again, potentially through the next day. Hello, there we go, we did so. Now we close above the swing point. We also have a swing point over here that you cannot ignore, because don't want to be making no mistakes. We close above that swing point as well. We would look to continue our trend higher, see what the market wants to give. We wick both the previous high and the previous low. So on this day, when it wicks both as well, I don't think I've had an example for that yet, but if we get a wick of both high and low and then close back within that range, it's an unclear draw on liquidity. So I'm not looking to take a trade on that because it's not clear, and it's just me guessing. For this, I would guess bearish, see, and be wrong. Why did I guess bearish? Because we just moved past the swing point. Maybe we're looking to retrace down, but as you can see, I was wrong. So that's why we don't take trades on days like that. Then we just continue the next day. We take the Monday off. You have a previous high getting closed above with a swing point just above as well. Daily draw on liquidity to the upside. Sometimes it edges you, you know what I mean? Sometimes it gets so close, it doesn't hit it, and then doesn't hit anything. Gives you a setup, and eventually this becomes a swing point as well. Just like so. Yeah, you need some volume, right? But hopefully you've been able to see like how the swing points work in relation to the draw on liquidity and how we can use this to find our daily bias. It is definitely a big help in the market. It definitely takes the stress out of trying to do all the guesswork of like what way the market is going to go, because that is impossible to know what way the market's going. Nobody in the world knows exactly what way the market's going to go. That is why we love this game, of course. But your homework, of course, is going to be jump onto the daily time frame. Literally do this, like jump on the daily time frame, zoom out, make it skinny, scroll back, hit replay mode, and just pick a random spot, chuck your chart into replay mode, and start going at it. Just start putting in the draw on liquidity and then start trading it. See what you can do. See if you're getting it. Take note of how the market's reacting, all that stuff. I could literally continue doing this forever. It's probably the easiest concept of the lot because it works very well. It doesn't always hit every time though, so do make sure that you know that. And of course, it doesn't guarantee a win just by knowing the potential direction of the market, but obviously, it's a very big help. So, homework, literally put the chart into replay mode, go through a bunch of price action, just determining the daily draw on liquidity for that next day. Make sure that you are mastering the swing points, and yeah, that's pretty much it, I would say. I think we've covered daily draw on liquidity. That is very exciting because now we are very, very close to finishing the Blue Rose trading course. We're not there yet, but we are so close. Only a couple more episodes, lessons left, I should say, until we are into this super good stuff. So very close. We actually, you know what? We know every single concept now with this one being completed. Every single trading concept is done. So the rest of this is just basically putting it all together and yeah, going from there. So we're moving into super important stuff, but we have our toolkit all set up. It is ready to go. We are ready to capitalize on these markets once we figure out how we should be utilizing our tools properly. So see you in the next lesson. And yeah, I don't know, just be ready for a doozy.